I'm going to go ahead and share my screen. Can you all see that? Can you see the start of the PowerPoint? Okay, awesome. Okay, so welcome back and welcome everybody. Kudos to you for having the courage to join on Friday the 13th. Like, we really need a Friday the 13th this year, right? So, how's everybody doing today? Maybe type into, can you all get into your, can you all type in the chat box? I know Sarah was cooking, but so maybe she can't. But I wonder how everybody's feeling today. You could type into the chat box. How you doing? Good, great. Oh, nice. TGIF, that's exactly what I was thinking. Okay, so welcome back for those of you who were on last week and those of you who weren't, welcome. I did give a little bit of a homework assignment, but don't worry, I'm not going to ask anyone to report on their homework. I know a number of you are looking at doing new businesses, so you're actually looking at having to create projections from nothing, and that can take some time. Blessed, Sarah's blessed, that's awesome. So don't worry about that. Don't worry about me calling you out or anything. I'm gonna bring up that spreadsheet again real quickly, just so we can do a quick review of it for those of you who are on and those of you who are new. Let me see. Okay, so in terms of what we're going to cover today, I just want to do a quick review of the 90-day financial scenario planner, so you can, so we can just kind of remember what that tool is. We're going to actually spend a little bit of time today. What we're going to really focus on is the break-even point. So this is a really important tool when you start looking at your projections, and then ways that you can affect the break-even point for your business, okay? So before I do that, I want to just do a quick poll. Harrison, can you launch that poll?
Yep, on it. Okay, just launched it.
Okay, so I want to kind of get a sense of your comfort level with business financial analysis. So if you could click which one of those 5 answers best describes how you feel about business financial analysis. Don't worry, it's anonymous, so nobody will know which one you click. Is everybody seeing the poll okay? Is anybody not seeing it? Okay. Okay, so it looks like I'm going to go ahead and let's go ahead and just close the poll out. It looks like most people don't have a lot of experience with business financials, which is really typical for small entrepreneurs and small business owners, right? I mean, we start our business because we know the product or service that we're doing. The business finance side of it is usually not the part that we enjoy the most or that we know the best. But I'm one of those kind of anal numbers people. And the thing I love about, I think I talked about this last week, the thing I love about looking at your financials as a business is that it really tells you the story of your business and how you're doing, gives you a lot of information about how you can improve your business, how you can make more money, right? Which is part of the reason that we get into starting our own businesses, maybe not all of it. Okay, so I want to first, before we start, I want to go back to the 90-day financial scenario analysis. And I want to real quickly remind you how to get there if you haven't downloaded it yet. So you can go to the Native 360 website, which I've pulled up here. So it's native360.org. Okay. So when you go there, you'll see here, right in the upper hand corner here, N360 initiate login, and you click on that. And that's going to bring up, if you haven't created an account yet, you'll create one and come up with a password. Mine automatically sends me there, tells me hello, which is so nice. If you need help with your projections and doing the financial scenario analysis, you click on contact a coach right here. And that's going to pop up a screen that's going to let you connect with a coach, Brent or Pete or somebody out of Felicia's office, right? To help you do these projections. Okay, so now I'm on this platform and I'm gonna go to COVID-19 right here. And this brings up a bunch of resources. So right here, we have our 90-day financial scenario analysis, which is what we're really focusing on last week and this week. And here you can download the template and a sample, okay? So that was just a quick refresher of doing that. So I wanna go to, actually to the template now. So this is the template that we went through last week. See, now I have the same problem like okay, I got it. Trying to move this stuff around here. Okay, so last week, what I asked you to start working on were the first 4 tabs of this spreadsheet. And really, most of the inputs are on this first tab, right? So if you have historical information for your business, you're going to put the months in from the last year's. For many of you, you're starting new businesses, so you're going to put in your projections. You can change any of this stuff here. I think we changed some of this last time, so we changed this to November, December, and January. So particularly when we're in times of uncertainty, we want to look at a shorter time period. Like projecting out a year is great, but it's really hard, particularly the way things are going now with COVID, right? It's really hard to know what's going to be happening in 6 months. So we want to really focus in on the next 3 months and see how, or if you're starting your business, the first 3 months, and look at what that looks like for us. So this is the input. These are all the inputs where you put in your sales, your cost of goods sold, your actual expenses, and then make any changes to those expenses that you think that you expect over the next 3 months if you've been operating. If you haven't been operating and these are new projections, these will all be 0 right here, okay? And then the second tab is we're looking at different sales scenarios now. So what happens if our sales are only 75% of what we think or 50% of what we think? And this is going to automatically calculate these for you. All you have to do is change the percentages. So if you wanted to know, well, what is it going to look like if my sales were 85%, right? And how does that impact my profit and loss? And all of that flows down. On the business cash flow, you just need to put in your starting cash and if you have any loan payments, and then all of this is going to also calculate out for you. This is translating this into a cash flow. And remember down here at the bottom, we want to put in how much money do I need to take out of this business each month? How much do I need to live? And in order to figure that number out, we go to tab 4, which is our household cash flow. So we want to then look at what are we going to need for our household the next 3 months and how much do we actually need to pull out of the business to make this work, okay? So I know that's kind of a quick refresher of these 4 tabs. Does anybody have any questions? If anybody actually was able to spend some time on this, or just as we go through it quickly, are there any questions out there that anybody has about this spreadsheet in particular?
Lisa, one thing, if anyone gets to working on this and you need assistance, I'm going to insert citizens coaches on there as well as Muskogee Loan Fund. But feel free to reach out to me, and that's what we're here for, is to walk you through, because I think once you would get your initial data in there, and if we can assist you, it's really going to make a clear picture of where you need to be for break-even analysis. So feel free to contact me via email. And we did check on that link there, on that coach's link, and for some reason it's broken, but John Rude is on, he's our IT guy. He is fixing it as we speak here. So hopefully by the end of the day, we can have that up and going.
Great. So thanks for bringing that up, Dino, so we can get that fixed. So the great thing about this spreadsheet is for, if you're not comfortable or you're not familiar, you don't feel like you're particularly skilled with business financials, the great thing about this spreadsheet is it actually automatically calculates all kinds of stuff for you. You just put in your actual expenses and sales, and boom, you can change percentages and you can automatically see how that impacts cash flow and your profit and loss. And today what we're going to actually talk about is break even. So a really cool thing about this spreadsheet is it's going to calculate it for you based on your inputs in the first tab. But I think it's really important to understand what this means when we're calculating break even. I got to move this little guy, he's in my way. Okay, so I'm going to come back here. I'm going to see if I can get my PowerPoint to work. Okay. So hopefully you all can see that. I can't, when I have my PowerPoint up like this, I can't see you all in my visual. So if you have a question, type it in the chat box or just unmute yourself and ask it, okay? Okay, so let's jump into the break-even point, okay? So what is the break-even point? So the break-even point is a really simple concept and a really important and powerful concept when we start talking about our business and understanding our business financials. So the break-even point is the point where we have just enough sales to cover all of our costs. So that means that our profit is exactly zero, right? We're making just enough money to cover all the expenses of the business and we don't have anything left. Okay, the other thing that's really important to remember when you're thinking about break-even point is it's going to be calculated for a period of time. So the period of time might be 1 month, 3 months. Quite often we'll see it being calculated for a year. When you think about the spreadsheet we were just looking at, that's a 3-month period of time. So when you put your information into that spreadsheet, it's going to give you your break-even point for those 3 months that you project, okay? But it is important to remember, so all of these things have to align when we talk about sales and costs. We want them to all be for the same period of time, okay? So why is the break-even so important? It's such a powerful thing to know when you're a small business owner, because it's going to tell you how much in sales do you have to make a profit, right? Like how much do you have to sell in order to be able to take extra money out of the business, which is something that every business owner I know wants, right? We all want to be taking money out of the business. We don't want to be putting extra money into it, right? We don't want to be spending more than we're selling. Now, when you're starting up, of course, sometimes that happens, right? It takes time to grow your sales. But once you are operating and your business is going, we really want to be making some money, right? The other thing it's going to tell you is it's really going to help you understand your cost structure. So you'll see when we go through what the break-even point, how we calculate it, we're really looking at variable costs versus fixed costs. And what that cost structure looks like really impacts your profitability. And so we're going to talk about that a little bit more. It can help you understand, can I hire another employee? At what point can I bring somebody else on to help? And so when you understand your break-even point, you'll know, and there are ways you can calculate, okay, if I want to bring on another employee, how much more in sales do I need to make, right? And then finally, if you're going to try to get a loan or some kind of financing, your lender is going to want to know what the break-even point is, right? They're going to want to know that you can cover their loan payment. And so that's something that almost all lenders will calculate when they're underwriting or evaluating your loan request, okay? So there we go. Okay, so the break-even point calculation, okay? So here comes the math. Get ready. Hope everybody's had their coffee. I'm really glad we don't do this in the afternoon or too late in the afternoon. So the break-even point is actually a pretty simple calculation, okay? You take your fixed cost for your business and you divide it by your contribution margin percentage. So what the heck is the contribution margin percentage? The contribution margin percentage is you take your sales, you subtract your variable costs, and then you divide it by sales, right? So what percentage, when you take sales minus variable costs, what percentage of your sales is that? So we're gonna talk about that just a little bit more. But if you look at this formula for break-even point, there are 3 things that you need to know in your profit and loss to calculate it. So what are those 3 things? If you look at the formula. So one of them is fixed costs. What else? You can type it in the chat or take yourself off mute. So we have to know fixed costs. What else?
Know your variables.
Sales, right? Right. Sales and variable costs. Exactly. Bingo, you guys are on it today. Okay. So if you know those 3 things, your sales, your variable costs, and your fixed costs, you can calculate your break-even point. So on the right-hand side here, I'm just want to remind you, last week we kind of did the P&L refresher. I want to just remind you about the P&L, right? So generally your profit and loss is going to be your sales minus your cost of goods sold. Cost of goods sold are usually your variable costs, and that equals your gross profit, right? So for every item that we sell, we have a direct cost with that. When we take that out, that gives us our gross profit. And the gross profit then tells us how much we have left to cover the rest of our operating expenses, okay? We subtract out our operating expenses and we get our net profit, okay? Okay, so I want to just for a minute talk again a little bit more about variable and fixed costs, okay? So I know we talked a little bit about cost of goods sold last week, and cost of goods sold are related to variable costs. Generally, variable costs are in cost of goods sold, but not always. Sometimes you'll find variable costs down in fixed costs. But let's talk about the difference, because it's really important when you start trying to determine your break-even costs that you understand the difference, right? So the easiest way, the simplest way to remember what variable costs are is that they're directly the cost of making a sale. So if you sell an item, think about it this way: is if you sell that item, you're going to have what cost go up immediately. So let's say I sell ice cream cone, okay? If I sell 1 ice cream cone, I know that I'm going to have to pay for the ice cream and I'm going to have to pay for the cone, right? Those costs are going to automatically increase for every ice cream cone I sell, right? But for my fixed costs are costs that don't vary directly with sales. So in other words, I'm going to have that cost whether I sell 1 ice cream cone or 10. So that might be my my utilities for my ice cream shop, might be salaries that I have, marketing costs, right? Insurance. It doesn't matter how many ice cream cones I sell. Now, if I have part-time employees that I hire to serve my ice cream, that's going to go under my variable costs, right? Because I'm going to have somebody come in and work to deliver the ice cream. And if it's slower, if I have slower times at night, I'm going to have fewer people in working at that time. Okay. So those are the difference between variable and fixed costs. Commission is a variable cost, right? Because if I pay somebody 10 cents for every ice cream they sell, that's going to be a cost I'm going to have if I sell one ice cream cone. Okay. So are there any questions about variable versus fixed costs? Sometimes this can get confusing as to where you find things or if something's variable or not.
Lisa, how would you handle it? This has come up with conversations with some of the clients that I work with. Like in the winter time, their utility bills just skyrocket, whether it be heating. So would you still consider that a fixed cost, or would you do that as a variable cost if sometimes the heating almost triples their utility bills in the wintertime?
Yeah, so generally with utilities, generally utilities are going to be in fixed costs.
Okay.
Now, there are some exceptions for that. So for example, if you have a manufacturing plant, okay, you may have a base cost for utilities, and that those are going to increase or decrease depending on your production level. So if there's a way that you can parcel out the difference, you can do that. Sometimes on utility bills, you can do that. But if you have an office and your office has, or you have a business space, and your business space, the utilities are always going to go up in the winter, right? Or maybe for some people, they go up in the summer because it's hotter and they're running the AC. But if that's just your general office expense, generally, I think you're going to put that under fixed costs. So unless you're really able to parcel out that those utilities are directly connected to if you increase your production, then I'm going to say probably you're going to put those under fixed costs. You're going to have to pay that bill whether you sell one extra ice cream cone or not, right? The other thing that can get confusing sometimes is, so generally all of the costs that you see in cost of goods sold are variable costs, but you can also sometimes find variable costs down in your fixed costs. So I think last week Sarah had mentioned, if I do a catering event, I hire people to help me. I might hire somebody to help me to do that. So again, in terms of differentiating those two, what I would say is if you have a salaried person or a person who you're going to pay regardless of if you have one event or three, that's going to go under fixed costs. If you're paying yourself as an owner a salary, generally that's going to go under fixed costs. But if you have somebody you're paying piecemeal, for example, so let's say, I think Sarah's case, she said, well, every time I have an event, I hire this person and I pay him or her $100 to be at the event, to man the event or whatever they're doing. Then that's going to be a variable cost. Just know that when you look at your P&L, some of those variable costs might come in under your operating expenses and not under the cost of goods sold. So you do want to check that. If you're not keeping your own books, you want to talk with who's keeping your books to make sure that you're picking up all of those variable costs.
Hey, Lisa, I have one more question for you. How, your bookkeeping firm or your accounting firm that does your books on a monthly basis or a quarterly basis, is it their responsibility to provide you with the information we're talking about, or is that an added charge that a lot of accountants will do it for additional fees?
Do you mean in terms of like, so generally your bookkeeping firm should be doing your profit and loss statement for you. Mm-hmm. And you're providing them the information, right? You're feeding them the information that they need to complete that.
Mhm.
They should be able to answer questions that you have. So I don't know, maybe I'm not understanding your question, Pete.
Is that something that a small business owner should just assume that your accounting firm will do, or is it something that the small business owner would say, hey, in addition to this, can you do a break-even analysis for me and a 90-day cash flow?
Yeah, I would not, no, I do not think that you should assume that your bookkeeper or accountant will do that for you. I think that's
Okay.
something that generally you have to ask them to do for
Okay.
you. But that is something they should be able to do because they're taking in those numbers and they're putting them in the chart of accounts where they belong. So they should have some idea about, what's fixed versus variable. But yeah, usually, in my experience, those type of services which are a little bit above the general bookkeeping, you're going to pay a little bit extra for. Does anybody have a different experience? Brent, have you seen in the clients that you've worked with, do they have bookkeepers or accountants who can do this for them, and do they get charged extra for that?
Usually when I do this is support with Pete, so there is no charge. That's our support, and we do this as part of the strategy to help folks do their business plan, and that's why I usually working with Pete and the folks and the clients is a business plan could take 6 weeks to build, because these are all the strategies put in place to help determine your cost, and folks I've worked with before really understand their business once we put this into place.
Yeah, so there you go. So if your accountant or your bookkeeper is going to charge you extra, just connect up with Brent or connect up with the Native 360 or the other groups that are providing support. There are a lot of free services around in your area as well. I mean, across the country that can help with those, like small business development centers and things like that. But the folks that are hosting this webinar, they're the ones who know, they're doing this every day. They're working with business owners every day. So generally though, you are going to have to get the information from your bookkeeper accountant if you're not using one now. And the one other thing I want to say in terms of the spreadsheet, the 90-day scenario spreadsheet, when it has the cost of goods sold on that, try to put all your variable costs in there, even if technically cost of goods sold from an purely accounting function, there's only cost of goods sold if you're producing a product. Okay, so technically, you may not show that you have a cost of goods sold, that you have variable costs if you're a service business, but you do. But you may not even have a cost of goods sold unless you're selling t-shirts or pens or some kind of product. Okay, any other questions around variable versus fixed costs? So just remember as a rule of thumb, if I sell one more item, is my cost going to directly go up? If it does, it's variable. If not, it's fixed. Okay. Okay. So I just had one more, this little chart, which I always find kind of helpful. Is this guy, like, could you guys see when I move this thing? You can, because it's kind of blocking my view. Okay, so for fixed costs, right, this is the blue line, it's flat. Actually, sometimes this is it'll actually be a stair step, right? Like if you start producing a lot of goods, you're gonna have a jump up in some of your fixed costs. So you might add a new salaried employee, right? Or you might have to add a new building or facility to operate, but generally it's going to be flat, and sometimes you'll see the stair step up. And then the variable cost is a direct proportion to how many products or services that you sell. And so when we add them together, this is your total cost, okay? Okay, so I thought maybe we'd try another Kahoot game. What do you guys think? Okay, so let's try it, all right? So for those of you who are, can use your phone or you're at a, let me see if I can get off of my, so if you go to kahoot.it, okay. You can do it on your computer or on your phone. Just a minute here and you'll see a code come up. I wanted to change the music today to disco because it's Friday the 13th. So I think disco is more appropriate. Okay, Dino's in, Beth is in, awesome. Brent's in, Omani's in. Janet's in. Wait, just another minute more. Is anybody trying to get in and having trouble or anybody wanting to get in? I don't want to exclude anybody who wants to play. Okay. Are you trying to, oh. Okay, Leo, no problem. You can watch, Leo, you'll see it come up on the screen and you can just guess the answer in your head, okay? Okay, so let's go ahead and start then. I think everybody's in who is trying to get in. Okay, so let's go ahead and start. Remember, the question will come up on the, I think you're gonna have to look at it on maybe my screen and then pick the correct answer on your phone or your computer. Ready? So let's go. So what is the break-even point is the question.
I like that one. I have to fire an employee.
Okay, everybody got it right. It's when profit equals 0. It's not when you start throwing things and smashing things. Okay, let's go to the next one. Which of the following do you need to know to calculate the break-even point? Okay, you guys are so on it today. So to calculate the break-even point, we need to know the fixed cost, the variable cost, and the sales, right? All of the above. Okay. Dino is in the lead. Which of the following is not a variable cost? Insurance, right? So commissions actually is a variable cost because we assume this means that if I sell something, I have to pay the commission on that to whoever is selling it for me. So I'm not going to have that cost unless my salesperson actually sells it. So that one can be tricky. Okay, I think this might be the last. I can't remember. Oh no, this is the fourth. We have one more after this. Variable costs are often found in which account? Everybody got it right. You guys are awesome. Right. So generally the variable cost will be found in the cost of goods sold. Sometimes they will be found in fixed costs. Okay. Now I think this is our last question. Fixed costs include the following. Okay, great. You guys did great. Oh my gosh, everybody got it right. Yep, all of them. Rent, salaries, property taxes, all fixed costs. You have to pay them no matter how much you sell. Nice job. Okay. All right. So let me see if I can get my PowerPoint back up now. Okay, so good job on that. Thank you for playing along for those of you who are able to get on. Let me see if I get my slideshow going again here now. Okay. Somebody was saying they know just enough about technology to be dangerous. That's like me. I can't figure out how to get all this stuff to work the way I want. Okay, so let's talk about now, let's actually jump into the break-even point calculation, okay? So I wanna remind you about the simple P&L, right? Sales minus cost of goods sold. In this case, we're gonna subtract out our variable costs to get our gross profit. And then the gross profit tells us how much we have left to cover the rest of our operating expenses, right? And once we subtract those out, we have our net profit, okay? So if you'll remember back to when we were talking about the break-even point, we talked about the contribution margin. So I want to talk about this for just a minute because it's a really important concept in the break-even point. The contribution margin really tells us how much of our revenues or sales are available to cover our fixed costs, okay? So the contribution margin is just sales minus variable costs. If all of your variable costs are in your cost of goods sold, it's going to equal your gross profit, right? So if we have $100 worth of sales and it costs us $50 in direct costs to produce those, we have $50 left to cover our fixed costs, okay? So it's called the contribution margin because it's the amount that we have left to contribute towards covering the remainder of our fixed costs. When we talk about contribution margin percent, we're looking at that amount as a percent of sales. So let's do an example here, okay? Let's say we have a restaurant and the restaurant does $100,000 in sales and the variable costs are $45,000. So that's the cost of their food and their direct labor, maybe their wait people, right? Their wait staff. Okay, so what would be the variable cost? What would be the contribution margin for this restaurant? If anybody knows, type it into the chat box. Do you know 55,000? Perfect. Yep. Dang it, come on, there we go. Okay, so right, it's just our sales minus our variable costs. So the contribution margin is 55,000. Now, what is the contribution margin percent, right? So if our contribution margin is 55,000, we're going to divide that by sales, and we're going to get 55%, 0.55, right? So another way to think of this is that for every dollar of sales that this restaurant has, 55 cents is available to cover the fixed costs, okay? So it's a really important concept when we start talking about break even. Okay, so now, any questions about that? Is everybody kind of following the contribution margin and the contribution margin percent? Okay, so the contribution margin is simply sales minus fixed costs, and then we divide that by sales to see what percentage of every dollar of sales that we have is going to go towards covering our fixed costs. Okay, so let's find the break-even point now. Okay, so if you'll remember back to that formula I gave you earlier, the break-even point is the fixed costs, and then we're going to divide it by the contribution margin percent. It's that simple, okay? So let's take a grocery store, okay? This grocery store has $100,000 in sales. Their variable costs are $60,000. So that's going to be all the food and all that stuff that the grocery store buys, right? And it has fixed costs of $20,000. Okay, so let's talk about, let's start with the contribution margin, okay? So the contribution margin is, remember, the sales minus the variable cost divided by sales. So what is the contribution margin? Sales minus variable costs. Does anybody know? Can anybody type that into the chat? What is the contribution margin? Not the contribution margin percent, just the contribution margin for this store. So to get that, we're going to take the total sales of 100,000 and we're going to subtract out the variable cost of 60,000, and that's $40,000. So the contribution margin is $40,000, right? Then to calculate the contribution margin percent, we're just going to divide that by sales, right? So 40,000 divided by the 100,000 in sales, that's 40%. Or 0.4, 40 cents, right? So for every dollar of sales that this grocery store has, they have 40 cents left after they cover their cost of those sales to cover their fixed costs, okay? So then if we want to calculate the break-even point, we're going to take the fixed costs. So we know the fixed costs are $20,000. We're going to divide by the contribution margin percent. And this means that we have to sell $50,000 in sales to exactly cover our costs, okay? I want to show you, so any questions about that? Does that make sense to everybody? I want to show you a really spiffy thing. So if you know the formulas, and you know your variable costs and your fixed costs and your sales, it's really easy to calculate your break even. So I know if I want, based on my variable costs being 60,000 out of 100,000, right? And knowing that my contribution margin is 40%, I know that for my grocery store, I've got to sell $50,000 to just break even. I won't make a profit, okay? So I want to show you on, oh, dang it, I closed it. I want to show you on the Initiate platform, actually, now that we've done kind of the heavy lifting on this and walked through how you come to the right answer, I want to actually show you how there's a spiffy little tool on the platform that's going to calculate this for you. Can you all see my internet now? Am I sharing my screen or my PowerPoint? I'm sharing my screen, I hope. Okay, so I'm on the Initiate platform here, okay? And I'm going to go to my COVID-19 and my 90-day financial scenario analysis is what we've been working on, right? And I'm going to scroll down and it says, oh, there's some other tools you might be interested in. One of them is the break-even profit calculator. So I'm going to click on that. And look at this right here. This calculator is actually going to calculate this for me. So now that you know how to do the formula, you don't really have to remember it. Okay. You can let the calculator do it for you. So let's do this. Let's put in, we had $100,000 worth of sales, right? And we had variable costs of, I've already forgotten, $60,000. And we had fixed costs of $20,000, right? Oh, look at that. It kicked out our break-even sales. It told us our contribution margin percent, and it told us our break-even sales, $50,000. Now, one of the great thing about this tool is you can say, okay, for my grocery store, I know I have to sell $50,000 in goods to break even, to cover all my costs, right? So how much do I have to sell? What if I want to hire another employee? And it's going to cost me, let's say it's going to cost me, let's just say for the sake of simplicity, it's going to cost me $25,000 to hire another salaried employee, okay? So how much more do I have to sell if I want to hire an employee that's going to cost me $25,000? Is it just $25,000 in sales? No, because remember, for every dollar in sales, I have direct variable costs, right? I have 40 cents. Was it 40 cents? My variable costs were 60,000. Okay, so I have 60 cents for every dollar I sell. I have 60 cents in variable costs that I have to cover first, because I know for every dollar in sales, that's an extra cost I have, right? So I can't just add $25,000 to my break-even sales and say, oh, if I sell $75,000, now I can hire my $25,000 employee, right? So down here, a really cool thing about this tool is you can add in extra stuff like, what if I need to take out a certain amount of money, right? How much extra in sales do I need for that? What if I have loan principal payments? How much extra do I need to sell to be able to make those? So let's say we put here, I want to hire a new employee and they're going to cost me $25,000. How much more do I have to sell now? Oh, I have to sell not $50,000, but $112,500. Okay. And right down here, it's going to give you the little calculation, right? So it's a really great tool. So you don't even have to remember the formula anymore. You can have Brent calculate it for you, or you can just come online and use this tool. So it's a really great little tool. You know, if I need to take out more money from the business, how much more in sales do I need to make in order to be able to do that? So it's a really cool tool. And the other thing about it is you can actually download this as a Excel spreadsheet that you can keep on your computer and you can play with it there. And there's also a help video, right? So if I want to learn more about how to use break-even and the target profit tool, I can go to this help video and learn how to do it. So it's a really cool, this Initiate platform is a great resource for you all to be able to get some tools to help you with your business, okay? Okay, so let's talk for just a minute now. Are there any questions about that before I just keep rolling through this? Okay, so we're almost done. Hang in there, we're almost done. Just want to talk about, okay, so obviously, what if our break even, what if we're not making enough to break even? How can we affect that, right? So there's 4 ways that we can affect our break even point and our profit. So think about it from a sales and an expense side, right? On the sales side, we can either increase our sales or we can decrease our expenses, right? So on sales, how do we increase our sales? We can either increase our sales by increasing the number of items that we sell or increasing the price of items that we sell, right? So one of the two could increase our sales. Just remember, sometimes with price, though, that can be a funny thing, right? Like if we increase our price too much, we actually might decrease our sales. But that's on the sales side. On the expense side, we can decrease our expenses by decreasing our variable costs or decreasing our fixed costs. So variable costs, one of the great things when you learn to do your cost of goods sold and your variable costs, you can go on and you can find industry averages for your industry. So for example, in the retail industry, the average variable costs or cost of goods sold are about 50% of sales. So if you figure out your variable costs in your retail business and you see that your variable costs are 70% of sales, that's an opportunity for you to say, maybe I need to find a supplier who gives me a better price on the materials that I'm buying, right? If your fixed costs are high, what are things you might be able to do to impact fixed costs? Maybe you have, maybe you can save on your utilities. You know, maybe you can do something to your machinery to make it more, to use less energy. Maybe you can, instead of hiring a full-time person, you can hire a part-time person, right? So once you understand where your break-even is and you want to impact it, you want to look at these 4 things and see what are the things I can change or manage. And when you look at costs, you can always look at percentage of your sales and look at your industry to get ideas if you're on track for where you should be for your industry. Okay. Any questions or comments about that or ways to impact your break-even price? So generally on your break-even or your break-even point, I'm sorry, do we want our break-even sales to go up or down? Do we want our break-even point for sales to increase or decrease? What do you think? So we want to make our break-even as low as possible, right? We want to be able to cover all of our costs with as little sales as we can, right? Yes, right. Good job, Amani and Leo, right. We want to decrease it. The lower our break-even cost, the more sales we have, the more we're putting in our pocket, the more we have to reinvest in our company, the more we have to repay our lenders, okay? Great. Okay, so again, I'll just show you really quickly on the 90-day financial scenario analysis, there is a break-even tab, okay? And the tab is right here, number 5. And it's automatically going to calculate this for you. You don't have to do one darn thing. If you want to put in additional things like, what if I hire staff? How much more do I need to generate in sales? It will calculate that for you as well. The main thing you just need to remember on this tool is to put your variable costs up here in the cost of goods sold, okay? Okay, so I think that's everything. And we're right at the end of our time. So any comments, questions, or any closing thoughts, Pete, that you have?
I just encourage everybody to, you know, as you work through this and start your business, reach out to us, because we don't want this training to be a one and done. Like, we're here for you continually through the COVID and through your business development and your business cycles. So always reach out to us, and we're more than glad to assist you or guide you in any way that we have to and connect you with resources. So feel free to reach out to myself or Brent, and then we'll connect you with Felicia's team and then Christopher's team as well in Oklahoma. And then the other thing that we're going to do with our training in December is going to be on QuickBooks, and we're connecting with a a group out of Alaska. So the neat thing, what we're trying to do is create a network of business owners for you guys to connect with as well. So we'll be connecting with a group out of Alaska. They're CDFI up there just like we are. And then also we'll be connecting with a group in Wisconsin. And then our Oklahoma friends will be connecting with them as well. So we're going to put together a nice a regional, this one will be all across the USA training platform for you. And then also the next time you register, what we'll want to know is what type of business you're in, because then what we want to do is we want to create little social networks where you may have a grocery store in Bloomfield, Nebraska, where you can share ideas and best practices with someone in Wisconsin. So it's going to kind of create a network and an overall social platform for you. So encourage, and the other thing that I do want to do is, like, any of you who have attended today, encourage your friends and your colleagues in your area to log on to our website and register for our next training, which will be December 4th and 11th, and that'll be on QuickBooks online training.
Great. Well, thanks, everybody. Have a great weekend.
All right. Thank you, Lisa.
Happy Friday 13th.